Imagine you're driving across Argentina's Patagonian frontier, heading northwest from the modest provincial capital of Neuquén. The landscape changes quickly. Rows of apple trees and neat vineyards disappear in the rearview mirror. In their place, a dry, desolate stretch of earth, dotted with steel oil rigs, cranes, and makeshift worker camps. What was once farmland is now a vast oil field in the making. But this isn't just any drilling site. What lies beneath is Vaca Muerta, Spanish for dead cow, one of the most significant shale oil and gas formations on the planet. It's not just an energy reserve, it's the cornerstone of Argentina's national recovery plan. The stakes are enormous. With inflation above 200%, soaring debt, and a currency in freefall, Argentina is in economic survival mode. And Vaca Muerta? It's being sold as the golden ticket, a resource so vast it could make Argentina energy independent, a resource so strategic it might even give the country a geopolitical seat at the table, allowing it to negotiate with Europe, reduce dependence on Russian gas, and reposition itself in global energy diplomacy. But here's the catch. Unlocking that treasure comes with an astronomical price tag, both economic and environmental. And just like oil, geopolitics always comes with a cost. So is Argentina's shale dream a pathway to energy sovereignty? Or is Vaca Muerta a resource curse in disguise, an economic mirage set to collapse under its own weight? Let's dig deeper. To understand why Vaca Muerta is more than just a local oil field, you need to look at the numbers and the map. This shale formation sprawls across nearly 30,000 square kilometers of western Argentina, an area roughly the size of Belgium. According to the International Energy Agency, it holds an estimated 16.2 billion barrels of recoverable oil and over 300 billion cubic meters of natural gas. That's not just enough to power Argentina for generations, it's enough to position the country as a serious energy exporter on the global stage. And the timing couldn't be more geopolitically charged. With the war in Ukraine disrupting global gas flows and Europe scrambling to break its dependence on Russian energy, there's an opening. Countries are looking for new, politically stable suppliers. And while Argentina isn't yet in that category, Vaca Muerta gives it the potential to become one. For Buenos Aires, this isn't just an economic lifeline, it's geopolitical leverage. If developed correctly, Argentina could start cutting long-term gas deals with Europe, challenge Russian and Qatari LNG suppliers, and even gain influence in energy-hungry forums like the G20 or the United Nations. The shale buried beneath Neuquén isn't just hydrocarbons, it's bargaining power. There's also a broader implication for the Western Hemisphere. Washington has long encouraged the diversification of global energy supply chains, especially among partners in the Americas. A stable, energy-rich Argentina could support U.S. regional strategy by reducing European dependence on autocracies and strengthening democratic resource networks in the Southern Hemisphere. But all that hinges on one critical factor: execution. Vaca Muerta may be a geopolitical opportunity, but as history has shown us, even the richest reserves can become national liabilities if mismanaged. The roadmap Argentina is following isn't new. It's modeled after the United States. 2 decades ago, the U.S. was heavily dependent on foreign oil, much of it from politically unstable regions. Then came the shale revolution. Through advances in horizontal drilling and hydraulic fracturing, American energy producers unlocked vast reserves trapped in shale rock. By 2018, the U.S. became the world's largest oil producer, By 2022, it was responsible for nearly 15% of global crude output, surpassing both Saudi Arabia and Russia. This wasn't just an energy story, it was a geopolitical shift. The U.S. went from importer to exporter, and with it, gained strategic autonomy. Energy security became a tool of diplomacy. Sanctions on rivals like Iran and Russia hit harder when Washington no longer needed their oil. That's the playbook Argentina wants to replicate. But here's where reality diverges from aspiration. Extracting shale oil is not cheap, especially in a place like Vaca Muerta. Unlike Texas or North Dakota, Argentina's shale fields face extreme logistical and technical challenges. Break-even costs range from $40 to $60 per barrel, almost double the average for conventional drilling. The terrain is rugged, infrastructure sparse, and operational risk high. There's also the issue of infrastructure, or lack thereof. In the U.S., robust highway, rail, and pipeline systems supported the shale boom. Argentina, in contrast, is racing to build basic transport corridors and lacks sufficient pipeline capacity to move gas from remote fields to urban and industrial centers. It's a bottleneck that could strangle growth before it ever reaches scale. And unlike the U.S., Argentina doesn't have the capital depth or policy stability to attract sustained private investment without major incentives. Multinational energy firms may tolerate high risk, but not high risk combined with low return, erratic regulations, and currency volatility. So while the geological promise is real, the path to success isn't a copy-paste of the American experience. It's a high-stakes gamble, and Argentina is playing with limited chips.
In the early 2010s, Argentina went all in on Vaca Muerta. The government opened the doors to foreign capital, relaxed regulatory hurdles, and rolled out generous tax incentives. The goal was clear: attract major players with deep pockets and shale experience. And it worked, at least initially. Argentina's state-run oil company, YPF, partnered with Chevron in one of the earliest and most high-profile joint ventures. That deal opened the floodgates. Soon, other global energy giants followed: France's Total Energies, the UK's Shell, and American firms with fracking expertise. Between them, they poured in over $13 billion across exploration, infrastructure, and production. The results were impressive. By 2023, Vaca Muerta was pumping roughly 250,000 barrels per day, with long-term projections aiming for 1 million barrels daily by the end of the decade. Roads were paved, pipelines laid, and Neuquén, once a sleepy provincial outpost, began to resemble a shale boomtown. But then came the policy whiplash. In 2020, the Argentine government suddenly slapped export taxes on crude oil. Just as producers began to see return on investment, margins were squeezed. Investors, already navigating a complex currency regime and capital controls, were blindsided. One year it's tax breaks, the next it's price caps. Royalties are adjusted, foreign exchange restrictions tighten, and contract terms fluctuate. This kind of volatility might be manageable in a market like Texas, but not in a fragile economy like Argentina's. And that instability isn't just bad for business, it signals something more dangerous to global markets: unreliability. For institutional investors, sovereign funds, or energy multinationals managing billion-dollar portfolios, Argentina has become a cautionary tale. Vaca Muerta was supposed to be a magnet for capital. Instead, shifting policies have turned it into a geopolitical and economic risk variable, exactly what energy markets hate most. As Netflix surged ahead with streaming, Blockbuster, once the undisputed king of home entertainment, began crumbling under the weight of its own inertia. You see, Blockbuster wasn't just slow to change, it actively resisted it. In a panic to catch up, Blockbuster finally launched its own DVD-by-mail subscription service in 2004. And at first, it looked like they might still have a shot.
By 2006, they'd racked up over 2 million online subscribers. Not bad. But there was a problem. They were late to the game, and Netflix was already 5 moves ahead. Reed Hastings had no intention of backing off. Netflix continued expanding its streaming catalog and subscriber base, and with every move Blockbuster made, Netflix responded smarter, faster, and leaner. And then, things got weird. At one point, Hastings joked that Blockbuster had thrown everything but the kitchen sink at Netflix in their desperate attempt to compete. A few weeks later, a box arrived at Netflix headquarters. Inside was a literal kitchen sink, mailed by Blockbuster. It was petty, it was symbolic, and it proved something. Blockbuster was more concerned with taunts than tactics. Meanwhile, Netflix was pushing forward with focused innovation. It experimented with reselling used DVDs, licensing indie films, and building its own content ecosystem. Not every idea was a hit, but that didn't matter because Netflix understood something critical. Progress comes from iteration, not perfection. Blockbuster, on the other hand, made one disastrous decision after another. First, they eliminated late fees, a bold move that cost the company an estimated $200 million in annual revenue. Then came half-hearted experiments with video game rentals and streaming trials, none of which gained meaningful traction. Between 2003 and 2005, Blockbuster lost 75% of its market value. By 2009, while Netflix was reporting $116 million in profits, Blockbuster was drowning in losses, over $500 million that year alone. In July 2010, Blockbuster was officially delisted from the New York Stock Exchange. A few months later, it filed for bankruptcy. The once mighty empire of 9,000 stores reduced to a single franchise location in Bend, Oregon, a living relic of what happens when innovation is ignored. And here's the ultimate twist of irony. A documentary about the last Blockbuster store? Yeah, it premiered on Netflix. So what went wrong? Blockbuster had the resources, the brand, the infrastructure, but it failed to see what Netflix understood from day one, that the future wasn't about physical product. It was about digital access, consumer autonomy, and frictionless experience. Netflix didn't just beat Blockbuster with better technology, it won with better vision. And that vision was about to evolve even further, because now Netflix didn't want to just stream content, it wanted to control it. In our next episode, we'll dive into how Netflix transformed itself from a platform into a studio powerhouse, creating original content that would redefine what it meant to be a streaming service.
After steamrolling Blockbuster and reshaping how we consumed entertainment, Netflix was sitting comfortably atop the streaming world. But Reed Hastings and his team knew something that would define their next chapter. Licensing content from others wasn't a long-term solution. Every time Netflix grew bigger, the studios it licensed content from grew more nervous. Prices went up, contracts got tighter, and the constant fear loomed. What if Disney or Warner Bros. Simply pulled the plug? So Netflix asked a daring question. What if we didn't just rent the castle? What if we built our own? The answer came in 2011 with a $100 million gamble on a political thriller called House of Cards. It was a bold move. Netflix wasn't a studio. It had never produced a show, but it had something the networks didn't: data. Netflix knew exactly what its subscribers were watching, when they stopped watching, and what genres kept them hooked. Based on that insight, it bet big, and House of Cards delivered. When the show premiered in 2013, it wasn't just a hit, it was a signal. Netflix wasn't just distributing content, it was creating culture. The success of House of Cards led to a content gold rush. Orange is the New Black, Stranger Things, The Crown, Narcos.
Each new hit solidified Netflix's identity as a creative powerhouse, not just a tech company. And then came 2020, the COVID-19 pandemic. Lockdown swept the globe. Movie theaters went dark. Production shut down. But Netflix? It was already built for this moment. Streaming became the default, the new normal, and Netflix became the escape hatch for a world in isolation. Subscriber numbers exploded, revenue soared, and yet nothing lasts forever. In April 2022, Netflix reported something unthinkable: its first net loss of subscribers in over a decade. For a company that built its brand on endless growth, it was a warning shot. Stock prices plummeted, analysts panicked, pundits declared the Netflix era over. Competitors like Disney+, HBO Max, and Amazon Prime Video were catching up fast. But here's the difference: Netflix didn't freeze, it adapted. By 2023, the company rebounded hard. Over 260 million global subscribers, a content library expanding across dozens of languages and cultures. And by Q3 of 2024, its stock had skyrocketed to an all-time high, $725 a share. While rivals burned billions chasing audience loyalty, Netflix tightened its belt and focused on what worked: compelling stories, global talent, and algorithm-driven precision. And they said it best themselves in a quarterly letter to shareholders. The challenge many of our competitors face is not investment, but engagement. In other words, you can throw all the money in the world at a show, but if nobody's watching, it doesn't matter. Netflix's advantage isn't just scale, it's understanding of behavior, trends, timing, and culture. And in the age of digital attention, that's more valuable than gold. But let's be honest, nothing is guaranteed. The streaming wars are far from over. Viewer fatigue is real, and tomorrow's competition could come from anywhere: YouTube, TikTok, or something we haven't seen yet. So the question isn't whether Netflix will stay on top forever. The real question is, can it reinvent itself again, the same way it did with DVDs, then streaming, then original content? If history is any indication, you wouldn't want to bet against them.